So, you've got a serious chunk of cash sitting around. We're talking $25,000 or more. And there's one huge question you should be asking yourself right now. In today's high-rate world, where's the absolute best place to put it? Let's dive in and figure that out.
It sounds like a simple question, right? But the answer? That could be worth hundreds, maybe even thousands of dollars. If you have a significant cash cushion just sitting in a checking account, you've got to know if it's actually pulling its weight or just, sitting there.
Because right now, this is what's on the table, 5%. That's the kind of top-tier annual percentage yield, or APY, you can get on your cash. I mean, that is a powerful return for what is essentially a zero-risk move. The real question is, how do you get it, and for how long?
And that brings us to a really crucial point. This high-rate party, well, it's not going to last forever. There's a real sense of urgency here, because the economic winds are definitely about to change.
Just take a look at this timeline. So the Federal Reserve has been keeping rates high, right? Trying to fight inflation. But the market, which we can track with the CME Group's FedWatch tool, is basically screaming that a change is coming. The odds of a rate cut in September are overwhelming, and it's pretty much a done deal by late October. And when the Fed cuts its rate, you can bet that savings rates are going to fall right along with them. This is exactly why the window to lock in these amazing high yields is closing, and it's closing fast.
So, acting now has a very real, very tangible payoff. Let's break down exactly what that means in actual dollars and cents over just the next 6 months.
This table just lays it all out. A single percentage point makes a huge difference. Let's say you have $25,000. Just choosing a top 5% account over a 4% one, that's an extra $122 in your pocket in just 6 months. And look what happens as the balances get bigger. With $75,000 at 5%, we're talking over $1,800 in half a year. That is serious money for doing nothing more than choosing the right parking spot for your cash.
Okay, so where do you find these rates? Well, pretty much all your options fall into 3 distinct buckets, and each one has its own set of products and its own rules.
First, we're going to explore the traditional stuff from banks and credit unions, savings accounts and CDs. Then, we'll look at what you can get from brokerages, like money market funds. And finally, we'll cover the ultra-safe options that come straight from the U.S. government itself.
All right, let's get into the nitty-gritty. We're going to put these options under the microscope and break down the most popular products in each of those 3 worlds so you know exactly what you're choosing between. First up, the workhorse of cash savings, the high-yield savings account. Its biggest advantage is just pure flexibility. You can move money in and out whenever you want, no penalties. This is what makes it the perfect home for your emergency fund. But here's the trade-off for all that freedom. The interest rate is variable. So when the Fed cuts rates, the rate on this account will almost certainly drop too.
Next up, we have the Certificate of Deposit, or CD. Now this is basically the opposite deal. With a CD, you're trading that flexibility for certainty. You agree to lock up your money for a set amount of time, say 6 months or a year, and in return, the bank guarantees you a fixed interest rate for that entire period. It's absolutely perfect for a goal with a specific timeline, like a down payment on a house you plan to buy next year. Just make sure you're certain about that timeline, because yanking your money out early will cost you in penalties.
So for bank products, it really all boils down to this one simple trade-off you see right here. Do you need maximum flexibility knowing your rate could fall? That's a high-yield savings account. Or can you afford to lock up your cash to guarantee today's high rate? That's a CD.
Real quick, let's touch on money market accounts. These are offered by banks, and you can basically think of them as a high-yield savings account with a bonus feature, a checkbook or a debit card. It's kind of a hybrid for people who want to earn a high variable rate, but also need to make a payment directly from that account once in a while.
Okay, now we're shifting gears into the brokerage world, and this is a really important distinction. A money market fund is not a bank account. It's a very, very low-risk mutual fund that you buy through a brokerage. So while a bank account is FDIC insured, these funds are typically SIPC protected. They're considered extremely safe, and their yields, which can actually fluctuate daily, are often some of the highest you can find anywhere.
You'll also see things called cash management accounts at brokerages. The easiest way to think of this is as the default parking lot for any cash in your investment account that isn't being used for stocks or bonds. The brokerage automatically sweeps this money into a high-yield option so it earns some interest. It's super convenient, but just like a savings account, that rate is variable.
And now for our third path, buying debt directly from the U.S. government. You literally can't get any safer than this. First up are Treasury bills, or T-bills, which are great for short-term needs of a year or less. But here's the key benefit you don't get from a bank. The interest you earn is totally exempt from state and local taxes. If you live in a high-tax state, this can make the real return significantly higher than what a CD offers. If you have a longer timeline, there are Treasury notes, or T-notes.
These let you lock in a guaranteed rate for 2 to 5 years, which makes them a really powerful tool to shield your earnings from those future rate cuts we talked about. And just like T-bills, that interest is free from state and local taxes, giving them a secret weapon over most bank products.
And finally, there are I-bonds, which are a totally unique product designed for one job: to fight inflation. Their interest rate is actually a combination of a fixed rate that's good for the life of the bond, plus a variable rate that adjusts every 6 months based on inflation. They are a fantastic tool for protecting the long-term buying power of your cash.
Okay, wow, we've covered a lot of ground. High-yield savings, CDs, money market funds, treasuries. So how on earth do you choose the right one for you?
It really all comes down to this core concept. Are you okay with a rate that can change? Or do you want to lock in today's high return for a set period? Knowing that rates are probably going to fall soon makes those fixed rate options like CDs and treasuries look especially attractive right now.
So, here it is, your action plan, a simple 3-step framework. First, ask yourself, when will I need this money? Is it an emergency fund for next month or a down payment for a house in 2 years? Second, you have to weigh liquidity versus a locked-in rate. Is instant penalty-free access a non-negotiable? And finally, step 3, just match your answers to the products. If you need flexibility, you're looking at a high-yield savings account. If you have a set timeline and want to guarantee that rate, a CD or a treasury note is your answer.
So here's the bottom line. You have a powerful but also a temporary opportunity sitting right in front of you. The options are clear, the potential returns are high, and as we saw, the clock is ticking. So the only real question left is the one on your screen. Where are you going to put your cash to work?